Hey everyone, hope they're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in and take a look, see what is going on today. If you want to follow me at @Finance, and if you want to join our community, finding-value.com, that's where I dive deeper into all of these topics and subjects, looking for potential investment opportunities and sharing those opportunities with everyone in the community. We do have a special going on. Special coupon code is special. That's what the coupon code is. 50% off the first month to try it out. And if you want to join a yearly membership, you can get a larger discount and savings using that same coupon code. So starting with Art Berman, it says oil markets are exceptionally vulnerable to price spikes because of historically large inventory deficits, which is orange in the figure below, which we'll go through. Prices have been low because of limited geopolitical threats. That will change, in his opinion. This is your inventories. So we get these small inventories. No, so this is back in the big spike, the big bull market in the capital. When capital was rotating last bull market for a commodities bull market. Pay attention to the inventory levels. We were actually increasing inventory levels outside of this small little deficit of inventory to the peak oil supply surge. And for the most part, this is comparative inventory surplus. We've had surpluses for the majority of the time. We had a deficit that was brewing in 2013 and 14, and obviously the market's forward-looking to some degree. And then you can see the inventory came on, and it says China economic slowdown, the great financial crisis. This is C19. And then we had the big move up. But what happened with our comparative inventory deficit here? That's a huge draw. We haven't seen a draw in history like this ever for oil. So this is the quote, Ukraine price shock, even though it had nothing to do with Ukraine. It had everything to do with how much money that was printed in the system. And look at the little inventory blip that we got in 2022. There we go, that little inventory blip. And this decimated the Strategic Petroleum Reserve with hundreds of millions of barrels. So what this says is geopolitics and inventory deficits push oil prices up. Economic weakness pulls them down. And what you want to look for is when you got this movement is when it goes down. When it goes down, this goes up. And then when it goes up, that's when you get it. So you can have a deficit go up like this, and that's when the price generally comes down. And then if you come back in the opposite direction, it drives the price upward. So as this declines, that's where your price moves up. And right now we have a decline in February of 25, but the price was moving down for some reason, some weird reason. But this is kind of history, and this is what it looks like in the cycle of adding to inventory and taking from inventory and the price movements of oil. Coming down, it says this hasn't broken yet, says Logan. And this is one of the main things that I look at for potential recessions. This is all employees, residential building construction. This is a big deal. When this turns over, it generally turns over and goes for a little while, and then you get your recession. So it turned over here, 89 or so, and then it turned down, and that's your recession there. Turn down, recession, turn down, recession. We haven't turned down yet. Could it occur? Yes, it could. I'm just stating that it hasn't occurred yet, and it's one of the things that that I look at as a leading indicator of a potential recession being driven by the markets and then the impact to the real estate market. So this can turn down, and it could go for some months before a recession does come. It doesn't mean it'll happen immediately. It's a leading indicator. Houses should not have returns compared to the S&P 500. They should get cheaper every year like TVs. Well, I mean, that's wishful thinking. That's, I mean, who has like the opinion like, oh, houses should get cheaper? It's like, okay, does land in certain locations, not all land is as favorable or as desirable as other pieces of land. So if there's only a certain limited number pieces of land around certain things that people want to be around, like a lake or an ocean or wherever, I don't know how houses would continue to get cheaper. I mean, maybe the house itself, but the land that it sits on could get more expensive because the desirability of it. So, I mean, California, they've had a massive move in home prices. And I consider California, the physical location of California, to be very desirable. Now, I don't like their politics. I don't like the state and their taxes and all that other stuff. So I don't go there. That's not where I'm going to live. And that's okay. But wherever desirability is high, that's where your expensive prices are at. So, I mean, if you want to go live in the middle of a field in Kansas or Missouri or wherever, you can do that. And I'm sure you can find cheap pricing. When you get around cities, when you get around things that are highly desirable, like lakes, maybe, I don't know if I'd be next to a river, but a lake or the ocean, then the prices are going to go up. I mean, that's kind of the way it is. And we're not manufacturing more oceans or more oceanfront property all that soon. So I don't know. Smart Real Estate Bets has a good counter. He says housing costs do get cheaper when we have an ample supply of them. That's why from quarter four 81 to quarter three 2020, the mortgage payment on a median priced home rose a whopping 34% or 0.7% per year, rising at well below the rate of inflation. But when we encounter a shortage, that's when ownership costs reset. Market forces are real, and scarcity of a non-discretionary staple is a powerful one. Totally agree. So it all depends on the supply demand balance, the market. Freddie Krueger says, I think Trump wants to crash so that he can get rates to 2%. Hey, other people are seeing this. I was getting some crap for calling an engineered recession. Why did I use the word engineered recession? Well, let's put the pieces of data together. Other people are seeing it. Well, that's good. But here's something that I find highly weird. What did Jeff Bezos do? What did I can't remember his name, Juan, however you pronounce it, the NVIDIA CEO? What did he do? What about Mark Zuckerberg? What did he do? What about Bill Gates? What did he do? What about all these insiders? What did they do? Wait, they sold their technology shares. Huh? Really? They sold all of them. What's Buffett? What did Buffett do? Wait, he sold his Apple shares? Oh, that's weird. And he sold a bunch of other companies like the banks and stuff. Well, that's weird too. So you're telling me that by sheer coincidence that all of these guys sold shares in their companies at roughly all of the same time before this pullback, and it was they just all timed it perfectly. Right. Uh-huh. So perhaps there's other reasons and drivers behind it, motives. We need to basically, I think what they're trying to do is get the 10-year and the 30-year yield down so that they can put some of the deficit or the spending that they've got, they can put some of that debt that is renewing out in the future. So I think there's also a driver or a motive there, which I think is coming here pretty soon for the that debt to basically roll over. I think there's a big motive there. What do you guys think? I said took the fractal from the 1960s, 70s time frame and put it over today. So this is, and I'm going to pull this up here. This is the SPX, and we can kind of scroll in and out here. These are the commodity bull markets. What I did is I took the fractal here, which is this guy, this one right there, and I put it over where we are today. And if you look right closely, I just took it where I lined it up as best as I could over it. And I think this is what will eventually occur. And if this is a good alignment, what this is saying is that stocks could go dormant, sideways, and maybe not break till 2037, a 12-year potential sideways movement. What makes me confident that that is a potential outcome? Well, it's the valuation and the cycle that we've seen in history. And we can look at the commodity to stock ratio. That is also supportive of what I'm saying here, where you get these large sideways movements. At the beginning of each of these ratios, all of them, stocks were expensive, stocks were expensive, stocks were expensive, and stocks are expensive every single time. And then at the bottom, depending on some of these markets, stocks were incredibly cheap in, I would say, this era here, because commodities went way up. Stocks were cheap in 09, which would have been this entire area there. And then the cycle just repeats over and over and over. Commodities are coming into favor. I can say that with some of the ratios, and I did post that there too, where I think this has the potential to go sideways like this. Now, did I time this perfectly? I don't know. I'm only talking about valuations and the valuation discrepancy between stocks and commodities. And then stocks are also expensive in relationship to gold and M2 money supply. And there's a bunch of other metrics. You can do price to earnings ratios, price to book. They're expensive in all metrics that we use, which coincide with a peak of every single peak here. Every single peak coincides with that. So that's what I think is coming. Now, could commodities get pulled down with this as it comes back down? For sure it can. For sure. And it is. It is having an impact. But we're entering that bull market, in my opinion. And I think the bottom was 2020 for commodities, which was here. The bottom here was 1998, 99. So the bottom was like here for the commodity to stock ratio. So you can see kind of where that lines up here. It was in the late 60s here where that bottom was. It was bottoming for a little while, but it was where that circle is. So the ratio bottom before we made the sideways action move in a lot of these. Commodities were cheap all through here. And that's the cycle, guys. And what drives the cycle, in my opinion, is the real estate cycle. We had a real estate boom here, but this year they forcefully revalued gold higher in this condition here, which created a commodity bull market. We went off the gold standard in 1970 in this one. This one here, we had a inflationary kind of a big boom in the real estate market, an expansion phase of real estate there. And right now we've got an expansion phase of real estate that we entered. And I think this is what is coming. That would be my best guesstimate there. And I think we could get dragged down for a little bit on here, and then we'll break. We'll break somewhere like in this region here where commodities start to take off. And we might get to sell everything if there's margin and stuff like that all kind of layered on top of it. And we are getting a pretty big pullback in the S&P 500 today. It's down 2.7% when I'm taping this. So coming on back, we've got the gold to SPX ratio and oil to SPX ratio. Now keep in mind what I just showed you up above. These are all interconnected. We had in the back end, gold got expensive to the S&P 500 in 1980. That was the end of the commodity bull market of a couple commodity bull markets ago. This was the other bull market here from 1999 to 2011. That was when gold had a big run. And now we're having another big run that we're just starting to break out of the downtrend. So we're entering this commodity bull market, which in every single commodity bull market before that, we had from 70 to 80, which was a huge move higher. We had from 99 to 2011, and now we're in another commodity bull market with a double bottom inside of a double bottom. And then we're going to work our way on up. That will reprice. Gold outperforming the S&P 500 is the commodity bull market, and it will reprice commodities higher. Gold's going to get revalued first based off the market conditions of a slowdown in the safe haven status of gold, and then commodities will reprice against gold when the inflation works its way through the system. They'll probably do lowering of rates, stimulus. That's what's going on. That's their response. And this is crude oil versus SPX. And so it looks a little bit more dirty, doesn't have as much history. We could also do US oil divided by SPX to get a little bit more history on it. So this is more history there. This is from 49 down to the bottom of 67. That's when the S&P 500 outperformed. Then oil outperformed all the way till 1981. SPX from 81 forward down to 1999 was an outperformance. We came off that bottom, and this is the cycle that we're going through. And then if we look here, we've got this is my opinion, we bottomed at the bottom of this falling support trend line, and I think we're going to move up. Maybe we hit the top of this, maybe we break out and go up here. I'm not sure what will happen after we do that, but this here is the cycle as we go up and down with the cycle here, and I think we're going to go up. And someone would say, well, why do you think you're going to go up higher than where we did today? Well, my reasoning is all of the other characteristics that we see in the market. You know, the SPX rolling over, gold outperforming the SPX, this one before it, and breaking out. Those are all signs, because everything is interconnected, in my opinion. And the valuations over in the S&P 500 and NASDAQ are incredibly high. So the cycle, that is all part of the cycle. It's all interconnected. The valuations are interconnected with the charts. The charts are interconnected with the market conditions of inflation, increasing interest rates. Then eventually that will weigh on the stock market and the valuations of the stock market. That'll roll over, which gives you the big long-term rollover here. This is where those interest rates weigh on the stock market, and it's all part of the cycle. I mean, you could even take this one here and kind of overlay it. They're all very similar here. The cycles there. It's the same cycle going on as before, and it just repeats over and over. So I think the commodity bull market's coming. And why is this important? Why do I focus so much on the long term? I focus on the long term because it can give you early entry points. And early entry points, if you're looking in the right location and you're looking in the right sectors and you get good early entry points and you can hold on for this big commodity bull market, you can use this as an indicator of when to buy and when to sell to some degree. Is it going to be perfect? No, you're not going to be perfect. No one's perfect. But that's what I think is coming. Anthony says, and I don't follow this guy, but I think what he's saying is true. It says, Trump told Jerome Powell to cut interest rates. Powell didn't do it. Now Trump is trying to force Powell to cut interest rates by crashing asset prices. We will see who blinks first. I actually agree with that. Because I know Trump wants lower rates. Powell said no, and then he's like, well, we'll engineer a freaking crash on you where you're going to have to cut your interest rates. And I think that's kind of what's going on. And other people are seeing it. It's not just me, and it doesn't matter if other people are seeing it. You want to go off of the logic behind it. Not it's not a voting mechanism here where you get as many people to agree with you, get a consensus, because consensus doesn't matter. It's all about who's right. But that's my opinion. I think he's trying to get interest rates to go down. A part-time trader says a whole generation that expected to get rich by buying speculative assets at the top of a bubble hurts to see people suffering, but the harshest lessons are sometimes the most valuable. Stay composed, stay patient, and improve your skills. And this guy's talking, he's 91% down from all-time high. 65% down of my savings put into crypto. Today, it's a real crisis for me, and I don't know what to do. Any of you in the same situation? Well, here's the tough part that I'll say. I don't know how to value crypto. It's like me looking at, like, say, like diamond rings. I know nothing about them. And I look at crypto and I'm like, I know a little bit about the design of some of the crypto and I don't like it, but I don't know what gives it value. Like it's people willing to buy it, but you could also say that's a Ponzi scheme, and people are attracted to returns. And if there's big returns, then you're just straight gambling, because I don't know how to value it. So what the takeaway here and what I've seen is that a lot of people get hurt by chasing returns. Now, some people will say, well, you can still get hurt in value stocks. You can still get hurt by market volatility. Well, here's the thing. Crypto can go to zero and it will never come back. That is a permanent loss of capital. That is what I mean by getting hurt. I mean, I don't know how to value these things, and who knows what the actual intrinsic value is. If it's zero, it can go to zero. If you're in a company that is completely underpriced, there's a couple of things that you can say about it. The underpriced sectors, if you've got a group of companies and they're all undervalued, and you're buying this undervalued sector, you can obviously tell that it's out of favor. That's how it's undervalued. And if you're buying something that's out of favor, generally you have to wait for the market conditions to come into favor. And that's why I'm looking at all these long-term charts of the S&P 500 and when I think this cycle could turn, where your undervalued assets start to outperform the S&P 500 and the NASDAQ and whatnot. The big driver, the big returns come from buying undervaluation because, one, your risk reward is better. Why is it better? Because the undervaluation, you're paying less for what you are getting. And when you pay less than what you are getting, that is how you protect yourself from permanent loss of capital. That does not mean that you can't go down. It doesn't mean it's a straight ride higher. What it means is that you're buying something for a price that is less than the value that you're getting out of the company. And it also, if you continue to do that, it means that you're avoiding the most expensive areas in the market. So what most people do is they chase return. And at the tops of these bull markets, people get more bullish as they chase the return, and eventually you'll hit a potential peak. And I don't know if this is the ultimate peak, but I'm just saying in general. And when you look at the valuations, your valuations are generally the best down here. Your valuations are generally, they get worse as you go up. It doesn't mean that NVIDIA is the worst valued company, but it keeps you in the right part of in the right sectors, in the right time, and you're in the cheaper area of the cycle. So it keeps you buying here and avoiding buying up here. The valuation does. And that's why I think when I look at the valuation approach, when I talk about valuation, so buying undervalued companies and that valuation approach that Buffett and some of these guys do, what it does is it keeps you in assets that are undervalued and early in the cycle. It prevents you from buying stuff that's up here more towards the top of cycles. And it doesn't mean that you will sell up here, because a lot of the times they hold these things forever. I'm not saying to hold NVIDIA forever, but a lot of the companies that they look at, let's use United Health. So here's United Health Group, which is an insurance company. So if you buy it when they're cheap and the values are cheap, and you can see the commodity ratio here, commodity bull market, commodity bull market, commodity bull market. I mean, it's in all of these. And this one ran in the middle of the commodity bull market upward, but it did have a couple of pullbacks. But it keeps you in the right locations. If it gets overvalued, you don't want to buy up here. You want to buy when it's undervalued in these locations. And then you just ride it. You don't have to sell it here. You just don't buy it there. And then you buy it on the dip and ride it all the way up. So that is where I think a lot of the value is. A lot of other people, in my estimation, is that they just chase price with they don't give a crap about the value of it. So when you chase price, you put yourself in these situations that are really dangerous. And if it's in something that has no value, you could have a permanent loss of capital, which is really tough to make back. Like, if something goes to zero, literally. Lance Roberts says one of the biggest reasons it's difficult to own a home, just because you buy a home, you never actually own it. And he's showing the home's property taxes, and the property taxes are going up. Basically, you're renting it from the state you live in with the property taxes. Conversely, though, if you rent, you're paying the mortgage of your person that you are renting from, and you're paying the property taxes, and you're giving him money on top of that, him or her money on top of that. So tell me which situation is better. Is it better to buy a house with a 30-year mortgage? That's what we have available to us in America. Lock in the interest rate, and hopefully it's at a low interest rate, and then let inflation completely destroy the mortgage. That sounds pretty interesting to me. And your property taxes will go up. So you're always going to have this property tax. So what I did is I bought in a state that has low property taxes. And yes, my property taxes, they went up $25 from last year. That's how much my property taxes went up from last year to this year. It went up $25. If you wanted to know, I actually looked at it and I was amazed at how little it moved. But that's better than me renting. My mortgage is about 1/5 of what I pay of what I would for rent. 1/5. And it will, in my estimation, will eventually be 1/100th. 1/100th of what rent will be probably 20, 30 years from now. So I'll probably be paying my mortgage, and that will be maybe a nice little lunch of me and my wife going out to eat for lunch 20, 30 years from now. That's what my mortgage payment will be. And rent will be astronomically higher. So coming down, breaking. Trump says a transition period for the economy is likely per CNBC, and adds, you can't really watch the stock market. Yeah, he knows what's coming. You're telling me that's not engineered by any sense? Now, it doesn't mean that he's engineering it for bad, but what it means is he's maybe slowing fiscal spending, trying to get interest rates down, and he's trying to force Powell to lower rates. And I agree with that. So he's putting pressure in the stock market. And then when somebody asks about it, you can't really watch it. Oil producers starting to hold back capital, the opposite of what the president wants. He wants the oil producers to produce, but they can't because they can't make money at this price. Sounds like a difficult situation. So when we go back up and we saw that there's all those inventory deficits that were in the oil market, eating through inventory levels. And then you also have capital not going back into drilling. Well, now it's just a matter of time. It's just a matter of time before oil prices have to go high enough based off supply and demand and the lack of inventory, where oil prices have to go on up to spur more production. If we stay in the 60s, that's not going to come. And we will lose production. We will lose supply. The VIX is taking a jog higher here, so we're getting a breakout of the VIX to the upside. And it is taking a jog higher. There it is. This is volatility in the market. It did break out, so we could see further downside in the S&P 500. That is completely possible. It's not looking too good. Here's gold versus the stock market. Now, this is now do silver versus the NASDAQ. It doesn't take a lot of rotation capital to get these small gold silver miners moving massively. Be prepared. And this is kind of like that double bottom almost, or a bottoming pattern. So you get a large selling pressure move, or the GLD to SPX, and now we're starting to break higher. That's the beginning of the commodity bull market. That's the beginning. And here's another thing that's kind of interesting. In 2019, we were trying to break higher here, and then we had that C19 event that brought us back down. So be careful. We might have another quote event to bring us back down lower if they think things are getting out of control, potentially. Freight futures, AM update, dry bulk's up 1%, Panamax is up 3%. So Capesize up 1, Panamax up 3, and tankers are also up 1 and 1. But I don't think that's helping them too much with the sell everything event. Even if natural gas injects at the 5-year average, the ending value is 3.578 trillion cubic feet, which is 200 billion cubic feet below the 5-year average. Normally, this might not seem like a big deal, but this year is an exception. Why? Because of this. This is what's coming in the lower 48 LNG feed gas in billion cubic feet per day. Up, 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 and up, up, up. We're going way higher in LNG here, and it's pretty steady from 2019 onward. So am I a natural gas bull on some of the natural gas equities? Yep, I am. And this is going to it's just going to go up. And I think we're going to see power burn go up too. Power burn is what we call electricity generation that is being generated by natural gas. That's power burn from natural gas. And I think that will go up with this. The part-time trader says, nothing has really changed for me. I still believe oil is heading higher. We're back at key support. If this breaks down on the monthly, I will reevaluate. Until then, I believe the downtrend gets broken eventually. And that's what we're looking for WTI. And nothing's changed with me. Even if we break below this support level and go like that, I still think that we end up higher in this bull market. And what I'm using for the bull market, there's two big things that I'm using. I'm using the fractals of the previous bull markets overlaid on top of this. So if I were to look at the fractal overlay, this is US oil from the long term. I take the previous fractal of the bull market and I overlay it on top. That is what's giving me some of the confidence that this is going to be happening. It'll still happen, no matter what. Could it go down in the short term to some lower level? It could. Yeah, it could. But I think this will eventually come up because of the fundamentals of the sector, because of the commodity to stock ratios, because of the valuations, the money rotation, all of those things are all aligning for oil to go higher. But in the short term, yeah, you're going to have a bunch of volatility and it could suck. Definitely. Right here, we had a pretty big pullback last bull market, right where we're located, which is right here. We went from $34 down to 19. And 9/11 was in this one too. That was a demand destruction event. I don't know, whatever they call it. But yeah, that's what we're going through right this second. We're right at that circle there where we had a pullback. Now, if we were to look at the pullback size of this, we can just kind of roll it down. It's about a 43, 44% pullback. This one here, we are at about 50% or so. Well, let me see if I can get this. Probably about there. We're probably about 44.19. We're real close. So the pullback in oil is about the same size as the pullback that we got last bull market. Are we at a bottom? I can't tell you that, guys. A lot of people, they'll say, oh, you're not right on oil. It's going to go down to $50. Okay, so what's it going to do after it goes to 50? If it does go to 50, do you think it's going to continue lower, or do you think it's going to go up and we enter a big bull market? Are you telling me that we've got all of this inventory, that these deficits don't matter? Are you telling me that the fair value price of commercial inventory levels of the inventory level that we're at, which is about 80 something dollars a barrel, are you saying that's wrong? Where's the inventory going to come from? Now, if we get a slowdown, maybe demand gets hit, maybe it doesn't. They don't know that. They're not looking at the oil market. And what if this isn't even a big recession? What if it's a small one? What if it's something that's not as big as others? I think a lot of people are trying to predict things that they don't know the outcome. So am I going to lose my position because of other people's predictions? No, definitely not. It's of still very, very good value across a lot of these areas. I'm going to remain long. Assuming WTI stays sub $85, U.S. frac fleet, by the way of attrition, will hit 200 by January 2026. ACDC, TCW, LBRT have been clear. Much less spare capacity than most realize. Tier 2 4 burns out after 7 to 8 years. U.S. is sleepwalking into a crisis. Yes, it is. So here's the thing that I think a lot of people may disagree with. They look at price and form a narrative from price. I look at the long-term fundamentals and I'm like, yeah, there's a problem here. There's a big problem in oil. I look at the long-term fundamentals. I look at the inventory levels. There's a big problem here, guys. There's a big problem. Now, they may have to send us into a recession just to hold oil prices down at $60, $70, $80. There's a problem in oil brewing. And I agree with this guy, 100%. There's a problem brewing with all of the infrastructure, the lack of capital spend, the lack of discoveries and reserves. It's coming. And it's coming like 2025 style. I don't think it's going to be that far out in the future. Here's another one that I thought was pretty good by Part-Time Trader. He says, this is a correlation between oil and gold. On a high enough time frame, you can see that they follow each other closely. I expect oil to pick up and follow gold soon. So here is gold and oil. Gold is the line here. Oil's the blue line. And as you look, these basically trade in tandem in almost all of these rotation events, right? Commodity bull markets. If you look, oil's kind of been the front runner, at least here, when it took off. Here we've got a mix. Gold was front running it here. We came on up, consolidated, and we're in a consolidation. Gold's running higher, like Forrest Gump style, like it's been running for years now. I think this is it's gonna follow gold. That's my view. And I think that the relationship, the ratio between gold and oil is going to stay relatively the same over time. It'll be in a band. And right now we are at a very cheap level for oil in comparison to gold, and that is exactly what we're seeing, is that gap. But the ratio generally hovers around 15 to 20. We're at 44. And 44 is the second, third cheapest time in history going back to the 1800s of when this chart was developed. Permian rolling at 67. I don't know. I think this is a wrong thing. I think it was rolling over before because it takes time for this to roll over. So in my opinion, it probably started rolling over with prices that were higher than 67. 67 is just the most recent number. It says you likely won't need an arrow to see the downturn if this hits $50 a barrel, as Besant reportedly desires. It says monthly U.S. crude oil production by region, it's already rolling over, guys. And here's another thing. You know, when these things start to roll over, sometimes it might be hard to get it to come back up. It may not be easy. So they kind of, I'll just say, we'll see what happens. We'll see where the price goes, and we'll see what production does. And we'll see if there's a deficit in inventories. And it could be kind of interesting to see that oil prices remain at a certain level, but inventories keep going down. That's going to be interesting. And that's what I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Special coupon code. And that's all I've got for today. So we'll catch you next time. This is Finding Value.